Brad Williams, Frugal Finance, managing your investments. In previous videos, we explored how financial market functions and examined ways to evaluate the performance of different investment options. We also discussed how to develop an investment plan tailored to your financial objectives. With that foundation in place, the next crucial step involves putting your plan to action and keeping track of your investments to ensure they align with your goals. Step 5, putting your plan into action. Once you have determined the right investment portfolio and strategy, the next phase is executing your plan. This involves deciding both how and when to make your investments. Choosing how to invest. Selecting the right investment method is important as choosing the assets themselves. Investors generally have several options, including consulting a financial planner or independent investment advisor, using a brokerage service, either full service or discount, hiring a professional money manager, investing in mutual funds or ETFs, purchasing investment products through an insurance company. Although these options were traditionally distinct, many financial service providers now offer a broad range of investment solutions. Choosing the right advisor or firm should be based on their expertise, service, and how well they match your investment needs. Independent financial advisors. Many investors prefer working with independent financial advisors who can help design strategies, select investment products, and monitor portfolio performance. These advisors often integrate tax and estate planning into their recommendations. Compensation models vary, including hourly fees, asset-based fees, or commissions from financial products. Full-service brokers. If you prefer a hands-off approach, a full-service brokerage firm might be ideal. These firms offer investment research, financial planning resources, and professional guidance in managing securities. In return, they typically charge higher commissions. Discount brokers. Investors comfortable making their own decisions may opt for discount brokers, lower transaction fees. However, these services do not provide personalized investment advice. Online trading platforms such as Charles Schwab, E-Trade, and Fidelity offer cost-effective ways to manage investments independently. Professional money managers. For those with significant assets, hiring a professional money manager can provide customized portfolio management. These professionals typically require a minimum investment amount and charge an annual management fee based on assets under management. Mutual funds and annuities. Mutual funds allow investors to pool resources and diversify their portfolio efficiently. Annuities, offered through insurance companies, provide tax-deferred growth with options for fixed or variable returns. Investors should carefully evaluate fees, liquidity restrictions, and potential tax implications before committing to an annuity. Step 6, tracking your investments in progress. After implementing your strategy, regularly reviewing your portfolio is essential to ensure it remains aligned with your financial goals. While frequent adjustments should generally be avoided, periodic assessments help determine whether an investment is meeting expectations. Evaluating performance. Investment performance should be reviewed in the context of overall market conditions and benchmark comparisons. For example, U.S. stock investments may be compared to the S&P 500 index, while international investments could be measured against the EAFE index. Risk considerations. Evaluating risk is as crucial as assessing returns. If an investment carries higher risk, it should also demonstrate higher returns over time. Metrics like beta, which measures volatility, and alpha, which measures risk-adjusted performance, helps investors understand whether a portfolio has performed as expected. Adjusting for life changes. Investment plans should evolve as financial situations change. Factors such as income fluctuations, tax considerations, and risk tolerance shifts may necessitate portfolio adjustments. Additionally, new investment opportunities may emerge that better align with financial goals. Key takeaways. Achieving financial success requires a combination of strategic planning, disciplined execution, and ongoing monitoring. Given the complexity of financial markets and the wide array of investment products available, leveraging available resources can be beneficial. To build and maintain an effective investment strategy, consider these key questions. What are my specific financial goals? What rate of return do I need to achieve these goals? Which investment products best match my objectives? What level of risk am I comfortable taking? Once a plan is in place, investors should diversify their portfolio to balance risk and reward, maintain sufficient liquidity for short-term financial needs, determine the best placement for assets within tax advantage and taxable accounts. Regularly monitoring investment performance and making informed adjustments as necessary will ensure long-term financial stability and growth. If you have any questions or tips about managing your investments, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.